Okay, well, again, thank you, Manish. Thank you, Cam, and thank you, traders, for being here. I'm going to dovetail on what Manish talked about and go into more details with support and resistance and trend lines and moving averages and really just build a foundation. He laid the foundation. We didn't compare notes before. We didn't do our comparison webinars, but this will dovetail very nicely with what Manish talked about and what you're used to with the Ichimoku. What we do for today's session, we'll be talking about filling, and I'll make this big screen, filling this 5 gaps in your trading. And I tend to be, in my trading style and teaching style, a generalist. So I'm more on the focus on the trading tactics, psychology, because the website's called Afraid to Trade. So that's what I mainly focus on, which is mainly putting a big picture narrative together. In our trading sessions, we go through this narrative, big picture, down to game planning. Whether you are a swing trader or an intraday trader, we're going to set the next session or series of sessions up with a plan, try to keep bias and emotion out of it, and then we'll do that plan as the market moves toward or away from our pivot levels and targets. Ichimoku, Fibonacci, Elliott, I use those in trading. I don't necessarily talk about them as much as I used to in prior presentations, but they're still a part of my active trading repertoire, and I do, of course, recommend those for those who like to study those methods. They work very well, especially Fibonacci and, of course, just simple trend lines. But the simpler, the better, it seems like, but building off that foundation. And today's session, we'll talk about, oh yeah, all trading involves risk. So, of course, can't jump in without saying that, but I wish it didn't, but it did. So again, no, as Manish said in his disclaimer, nothing is said to purchase a security or to make any sort of trading decision off of our presentations, but to give you information, share some knowledge. Manish and I worked together for years now. I've been colleagues and friends, and so I'm very, very pleased to be here, happy to be here working with him and with you all. So again, thank you for the opportunity. And as you said, trading does involve risk. So what we'll do is talk about these areas, and of course, just if you're not familiar with my work or my background or how I approach the markets, I started in 1999, so I'm a little bit older than I look. I'm 34, so not a teenager, not a kid, but definitely started in the bull market. We'll talk about narrative and how that plays into it. Rode that up, rode that down, turned to technical analysis a few years later, which met my kind of pattern recognition, mathematical indicators, and sort of, as Manish mentioned, sort of technical analysis, engineering background. So science, mathematics, statistics, that spoke to me. And that's where I've been ever since for, goodness, 12 years now as a technical, meaning chart reading trader, studying all matters of indicators. I'm a CMT, as Manish will be soon, which is just a charter market technician. And that is a, goodness, almost a grad school program in technical analysis and trading methods and strategies and information and all sorts of things that you can possibly think about for trading. Not necessary to be successful, of course. Just even simple methods, as we'll keep stressing, will help you as a trader. And you just build on your foundation, build on success, build what works. And like anything else, do more of what works for you and less of what doesn't. We'll talk about that too. A lot of traders seek out the holy grail, and that just doesn't happen. There's no magic indicator. There's no magic method. It's just figure out what of the many, 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 many methods work for you, which of the time frames work, maybe which markets, futures, options, forex, etc., and then stick to it, commit to it, and improve every single day. And so I moved from Alabama to Los Angeles, from AL to LA 2 years ago now. And I was the author of Complete Trading Course from Wiley, and also from Wiley, the Profiting from the Life Cycle of a Stock Move. And I give the morning market briefing with TradeStation on Tuesday, just to mention a few things of what I do. What we do, and talking about today's presentation, I loved how Manish was interactive with you, and I want to make that, to carry that passion through. And I want to make this interactive, so I don't just want to talk for an hour. I would like you to take part if there's any questions. And there's going to be 5 sections, of course. There's 5 gaps we're filling, 5 areas to overcome. And let's talk about those. So if you have any thoughts, ideas, suggestions, feedback, comments, we'll take that into consideration, because that will make the presentation much more fun. So what we'll do is this. There's 3 areas I want to talk about, or 3 points. Make improvements every single day, whatever you do. Day trader, swing trader, investor. Make little changes, focus on these areas, and it's all about day by day, step by step improvement. It's not about becoming an overnight success. wish that were possible, and some traders will try to sell you that, but it's putting in the work, doing the research, doing the trades, and I think importantly, reviewing what is going well in your trading performance and your personal trading performance, not anybody else's. You're the ones putting the trades on and choosing the strategies. So find again what's working individually and what's not. And sometimes even time of day. I'm personally better trading the market in the morning as opposed to the afternoon. So that's even a slight change just by that. It's something you might not think about. But you get those changes by referencing your trades and by reviewing your trades each day. And most importantly, small changes can lead to big results. So it's sort of how does one eat an elephant bite by bite? Or how does one create a journey of 1,000 steps? Or a journey of 1,000 miles, start by one step. So just big things can happen if you do improve and make performance and like small changes as they're needed each day. So as we progress, number one is something we don't talk about much. I don't see this discussed a whole lot in the trading community, but it's helped me a lot. This narrative gap concept of the bigger picture, no matter what indicator, strategy, market method, time frame, anything we use, we need to figure out and focus our attention on what's moving price, what are the really themes, what's happening, and once we understand these and make notes of them, they don't really change. I got started in what was later called the tech market. Well, we'll see this here. We'll take a look at just this, the tech market bubble. Later, I got involved in the tech market crash. Most of us did. We had a low volatility recovery, which led to kind of overheated housing prices. Had the housing market began to be in focus, led to the financial crisis of '08, a little bit into '09. Had an intervention, liquidity filled recovery with stimulus measures. And we had, the reason I froze this chart here, I gave this presentation, goodness, now 3 years now, in San Francisco and Toronto, at least I'm using this chart, that is. And the point is, narratives don't change. The narrative we had 3 years ago, which is a liquidity-fueled economic recovery, stimulus plus recovery economy, that is still the narrative today. And we'll see that. All right, so with the narrative, just what's the main factors? Yeah, exactly, QE. And we'll talk about that's precisely it. I mean, that's really down to the picture QE. But there's more to it than that, of course. And this is whatever market you trade. We'll see a chart of oil coming up shortly. Gold, Forex, anything you talk about will have a narrative. It will have supply-demand moving in a trend and things affecting it. International ETFs, international markets right now are driven by, well, two things, really more than two, but mainly Greece at this moment and China, emerging markets and things like that. So those are factoring into an overseas narrative, but I focus on the S&P. I'm an S&P trader intraday, and I do swing trade with stocks, leading stocks, and some ETFs. But I focus my main trading activity on the ES futures. So I'm more interested in that. So what's driving the S&P? Study your charts with the bigger picture of what's happening. Can use sector strength, internals, breadth, all those things. But it's really a story. That's living in Hollywood here. You're into people that are writers and actors, and that's really it. It's a narrative. What theme, what actions, what items are, what's the story driving price? And again, we'll say QE shortly, but I would say the big things is the economy is recovering, which is bullish, but it's also being boosted, has been boosted by 3 periods of quantitative easing. Now Europe is doing it. And, of course, easy monetary policy from the Federal Reserve. It's almost like the recovering economy is a fire that's lit, and the stimulus is kind of like gasoline or fire starter or liquid fuel that's pushing the fire even higher. So that's really where we are, and it's simple narrative. And so that's as we go through the picture. All right, so that's the narrative that we went through there. Crude oil recently, actually last year, going into the 2015, there were 3 factors that plunged oil from 105 down to 45, cutting it more than in half. What did that? Was that foreseeable? Was that possible to predict? Magnitude, sort of. At that time, we were going into a global economic slowdown. Demand was down. OPEC policies, they actually did not. Typically, they will reduce their production if they see on the horizon the lower demand. They didn't. They increased production. and the U.S. increased production. So as you see, demand down, production up, that collapsed the price. And that was a narrative that if you didn't see that, or at least have those, you don't have to be perfect in a narrative. But if you miss the narrative, if you're short selling a market that is going up in terms of the tech bubble or the QE markets now, if you are buying markets like oil or during the financial crisis, you're against the narrative, you're against the trend, and that probably won't work. It typically doesn't work to fight the trend. And Manesh mentioned that too. Trend, trend, trend. As I've done this invested for about 6 years and now traded for over 12 at this point, the narrative, the trend actually, which is part of the narrative, that is really the key to successful, easy, efficient profits. Position your trades, whatever indicator, method, strategy that you use, in the direction of the prevailing trend. So Chris mentioned this, and there it is. What do you think are the factors in the current, and don't oversimplify, but maybe type in what you think. Greece is part of it too, of course, global China growth, debt still is out there, QE Europe, those sort of things too. What are some other things in the S&P narrative, or the Dow, or the NASDAQ right now too? But just saying, yeah, Pamela says we're at a 91-month high, and sure enough, we are. This has been one of the most stellar uptrends, and it really is only comparable, well, there's more periods, but comparable to that 1999 irrational exuberance, where people in the long run were right, saying, gosh, this is crazy, it's overdone, fundamental valuation is out the window. But if you short sold the market, that really damaged your trading account. Even despite that was literally was at that point what we call irrational exuberance or craziness. This is a same thing. So 91-month high. Chris says trader sentiment. And trader sentiment is in there. This has been called the most hated bull market in history. It's probably hyperbole, but not far from the truth, I would imagine, that this thing just keeps going and it doesn't really pull back. It doesn't really give us nice chances to enter. And that's part of it. Yes, interest rates, Russ is 100% correct. Interest rates, because the Federal Reserve really slashed rates down to essentially zero, effectively zero, in late 2008 and hasn't moved them at all. So that's, of course, low interest rates are bullish in terms of borrowing at cheaper cost and stimulating growth, which is exactly what they have done. Dave says dominated by uncertainty. Looking tired, precisely. And let's talk about that really quickly. I spent too much time with the narrative, but I think this is why I chose this number one, the first point, because traders don't. They just look at the chart and say, oh, a support level, oh, a moving average or a bull flag or whatever, the Elliott third wave, whatever you're looking at, you might not see the big picture. I think that's very important. Looking tired, and that's it. So markets, before they pull back and retrace, typically do what we call overlap, or they trade sideways. So this is what's happening in 2015. It's just sideways bar overlap, trading into rectangle, which looks a little bit similar, doesn't it, to 2011, and maybe a couple of other times here in 14. So yeah, it's looking tired. And one more, Russ says low VIX, which is your volatility index. Absolutely, absolutely. Let's take a look at that VIX. Just 1 second, because I think that's fun to look at too. The VIX, take a look at the weekly chart, VIX. And there it is as it pulls up. The volatility index, which just measures sort of price movement. Yeah, it's not necessarily not at all-time lows, but it's coming up off this consistently low level at about 11. VIX 11. At the height of the crisis, it jumped all the way up there to 80. So this is your volatility index. But it's been long. We can't just say, well, the VIX is long or the VIX is low, therefore the market's going to top. That obviously doesn't make sense. It's just a low volatility environment. That is part of the narrative. Very good. All right. So the chart gap with the narrative in focus, and let's talk about the chart gap. So once we have that, once you label, and we do that with the membership reports and on the blog as well, just talk about the narrative. Once you have the narrative, I really suggest writing it out and keeping it by your computer. Oil is doing this. Stocks are doing that. The narrative is this, and it's a sentence. The economy is recovering, but it's done so with the help of stimulus, which is a good thing, although it's tired and looking a little bit different. But nonetheless, that is the narrative. With gap number two, would be the chart gap. And there is a balance here. We are seeking balance between too many, which I did it when I first started, and too few, which I get sort of involved with as well as a pro trader. Just sometimes we don't need indicators, but they're good to have some balance. Ichimoku, Elliott wave is a strategy. Fibonacci is a type of indicator, retracement indicator. I like moving averages. They help guide my decisions. Bollinger Bands I'm okay with, and just candles. So I typically look at those factors, but it's the balance of too many. If you put too much on there, that's it. So chart gap is how do you find the trading opportunities? Manesh had a great example of one opportunity with retracement trades in a trend with the Ichimoku overlap. That's a way. That's a specific way to find trades using an indicator, using a trend. That's how the method is coded. How do you separate signal, all the lines? There were a lot of questions about what is this line, what does that mean, what is this? Well, that's signal versus noise. As you get better, as you learn, as you study, this becomes easier to focus on opportunity versus just randomness. And we want to avoid randomness if at all possible, and only trade our capital, only risk our money when the market is giving us a signal, not just because we're bored and want to trade. Find the right indicator and chart settings, and I'll keep coming back to this for you. You won't trade like Manesh and I don't trade like Manesh, and we're not similar traders. At least we're not similar in the exact same style. Most traders aren't. We find what works for us based on our experience, what we like, our risk tolerance, and then build upon success. And that's how it typically works. And it's a personal decision. So that's your balance. Too many indicators versus too few. This is probably too few, although arguably this could be done just trading price. How do you find signals? So tell me, how would you find signals in this chart? What would be an example of a trading signal? Just that's all it is price and candles. What might be a signal here? Yeah, it'd be trend lines. Yeah, exactly. Tom said exactly. Higher high, higher low. That will define a trend. Maybe a breakout above a higher high. That's a trade. This example at 1900, popping higher. Anytime it breaks higher is that, or higher highs, higher lows. Exactly. Kenny says trend, precisely. Trend lines. Yeah, Jeffrey's right. Candlestick patterns. Draw a trend line. Dave says draw a trend line. Pivot points, Richard, and then pivot breaks from Edward. Perfect. Those are all valid. And it's kind of a trick. I was tricking you because candles actually can give you signals. And these, when combined with, I think it's more important to combine candles with something, be it trend lines, prior price pivots like this coming down into 1900. And as we know from the hindsight, trading back up. Yeah, good to dovetail with Manesh. Peter says support and resistance. Precisely, of course. 1850 and all the other ones form trend lines and just simple support resistance, or as Manesh said, more important or significant levels. Precisely. Now, how do you find signals here? What do you do about that? Anybody see? Well, I'm sure we all can pick out our own signals. Look, it's a crossover. Look, the volume is the momentum. The MACD crossed over. The stochastic has a buy. The RSI has a buy. The candle, it's a bullish engulfing candle. Oh, the RSI is, goodness, or the what's it called? The DMI and the parabolic SAR, Bollinger, just on and on and on and on. Right? So anybody have this problem? And be honest if you do. If you have too many indicators on the chart, if it works for you, I'm not going to judge you and say that's, yeah, Dave says it used to. Perfect. I'm not going to judge you at all. Again, I've done a lot of things. I used to print charts off every day and by hand use about 4 or 5 indicators and line them all up. And you can so be assured what happened next. There really weren't any signals. Trading is not perfect. There isn't a perfect signal. It's just doing, as Manesh said, you're doing probability. And Tom also says, even if you get that, it's too many charts. So you can even have not just too many indicators, but too many charts you're looking at. I was guilty, or I sometimes am, with all my scans. Sometimes it's fun to scan, but you have to make a decision. So all this is about making a decision, coming to a signal, getting the signal, which is an entry, exit, management, stop position, or stop target. And by the way, a trade is going to have an entry trigger. It's going to have a target, it's going to have a stop loss and then management in between. So as long, and a bull flag is a trade, and it's just a price pattern. So that's how we progress on those. So not to belabor the point, but using indicators, there are categories of them, and do not duplicate. For example, trend line, linear regression, MACD, moving average, ADX, just to name a few, those all determine trend direction and strength. Sentiment, we like sentiment, but these are all similar, but they show similar things. Volatility, so on and so forth. So just for the categories I tend to look at, not all the time, be momentum, trend, sentiment, volume is important, volatility. So you don't have to use all of them. You don't need any of them. You just need something that works for you. And as we talked about, you all mentioned earlier, we can look at price and formulate trend structure, trend lines, all of that. Just that's my point of this is a lot of traders either use too few or too many. So keep that in mind. If this is a problem or a concern, a solution would be cutting back or focusing on ones that you, Dave says RSI does the job. Precisely. The RSI is a good indicator, and that's this right here. Overbought, oversold. Stochastic, which is this right here, the green and or red and blue, or fuchsia, whatever, or cyan, that's pretty much identical. So RSI and not really, but RSI and stochastic are very similar indicators. And of course, there are multiple ways to look at volume and sentiment and volatility. Bollinger Band, Keltner channel, true range, etc. So focus on what makes sense for you. Problem, too many, too few. Solution, cut back or add one or two. All right, so the planning gap is, David says the momentum is a great confirmation of RSI. That's what I use. And of course, I'm not teaching indicators in this particular presentation, but I'm a fan of Linda Raschke's 310. And that's just, it's a momentum oscillator. I like to focus on divergences. And it's momentum. Confirmation, non-confirmation. It's also a Dow theory concept. All right, moving on. Number 3, if you've got the narrative down, you've got your chart balanced, well, let's talk about planning. A lot of traders will just, everything that I talk about, I've done it many times. So that's how you become successful. A lot of times you just make mistakes and sort of learn from your mistakes, which is the 5th one, review gap. So planning every single day with the membership report, with clients, and with traders that I work with, this is what we focus our attention on in the evening. So I've written a report planning out the next day, particularly S&P or some stocks, I think every single day since 2009, April 2009 is when I first started doing the membership site. So this is, I can't underscore how important planning out the next day is. It keeps you from walking up and saying, my goodness, I'm taken by surprise, what do I do? Or being emotional and jumping into a price move when you aren't really sure what the targets are, what the market should be doing, and what the market, I think most importantly, should not be doing. And so that's it, just creating, and I've given full presentations on this in the past. It's just simply creating a game plan for the next trading day. So there's really just a focus, develop a dominant, which is logical, which is based on the evidence of technical analysis or chart patterns or indicators, logic, or the trend, what should happen tomorrow or the next couple of days. And don't stop there, an alternate thesis. An alternate thesis is, we'll call it illogical, unexpected, lower probability outcome, but you have to be prepared for that. If you are not prepared for an alternate thesis surprise move, Manesh mentioned his little, the market goes and tags the support level, goes under it, and then just goes right, carries on like nothing happened, it's despite the fact that you got stopped out. Do you get back in? Do you throw your hands up in frustration? Or do you have that plan in place and know what to do if this just becomes if then? If this happens, then I will do that. If you're a market profile or just any type of trader that uses probability, we are trying to find the answer with these questions. What is the market trying to do? In a trend, it typically is trying to move higher or lower. And it's, as Manesh says, support resistance, interacting with a key level. I loved his presentation, his point right on par about that. Price is at a key level. It's either going to go one way or the other. if you put a bet, a probability, a trade on, your stop at that level will be very small. So that's what a pivot point, support level, resistance, trend line, or in cases moving average, that's why it's important. Is price interacting with a key level? And we always frame in the membership reports the terminology moving toward, or the market briefings or whatever we do, price is often moving toward or away from a certain level. And our trades on an intraday basis or a swing basis will be in the direction of that movement as price moves toward or away from a level. Just recently, we'll see this. We'll go back to TradeStation just a moment here. Just recently, price moved down away from 2100. And this is, let's go to the daily chart just for fun reference. So price was pivoted at 2100. Pretend like we don't know what's going to happen next. So it's at the midpoint. There's your sideways trading range as it develops on here. And it's coming down. Price is at 2100. It's either going to pivot up off of it or down beneath it. And we have a target. That's 2075. As it were, we stepped in the market. Greece was the headline. And the market immediately moved down away from 21, down toward 2075, and then even toward a lower target, which was your 200 SMA, simple moving average, 2055 thereabout. And the market now will either move up away from that pivot, or if it in the future breaks 2055, down away from. And then Pamela says tons of volume and open, exactly, tons of volume and open interest at 2100. And that was options going in the end of the month here, Friday. And probably be there by Thursday. Yeah, well, it's actually today's quarter end. And so that's kind of a cool thing. Nonetheless, the market is the game plan as we go through this. We'll pivot off of 2070 and 2055. That's just a little bit of real-time analysis there, but that's what we're doing. So we ask these two questions. What is the market trying to do? Interact with the level, move toward or away from? And how well is it doing it? We talked about the trend. Always start with the trend. The market is trending up. That's a fact. There really isn't any way to deny that. It's just, there's nonsensical. It's higher highs, higher lows, rising moving averages. But how well is the market trending up? Right now, one of the attendees mentioned it, not so well. It is looking tired. It is looking like a distributive or distribution top, and there are divergences. So even though it's going up, it really isn't going up very well. And as we saw with yesterday and Monday session actually, the market didn't go up very well, to put it nicely. All right, so in game planning, we talked about it just briefly, but this is back to a prior reference with a good example where the market's into resistance, a little bit of a divergence, sell volume, and this is the pattern. It's trending up, yes, fact, but it's into resistance with divergences. We don't know what's going to happen next. So here's an example game plan. So given the current condition, this is a fact. It's undeniable. It's objective. Price is into resistance with divergences as it was a few days ago. So the dominant thesis is that it will come down from resistance. We expect that. That's logical. It will come down from resistance. If it does, we will trade short against it intraday or swing trade short. All right, wonderful. Most traders have inefficiencies because they stop here. They don't plan for the market doing the alternate thesis, which is, if we go back to it, jumping to a new high and power rallying on a short squeeze or a continuation of the trend. They don't plan for it because they don't think it can happen. And they get caught losing a lot of money. Unnecessarily, I might add, because the alternate thesis should be in place. That if the market's into resistance with divergences, but it breaks above in real time, it probably will jump much higher. And so we will, in real time, trade aggressive, what we call popped stops, or just a short squeeze. Just means trading bullishly. This is a planning example from not too long ago. Market was into S&P 1980, multiple levels of support, multiple reversal candles, multiple positive divergences. Don't worry about that so much. But as the market came up, what's the expectation? And here's the daily chart. So Manesh mentioned time frame analysis, 30-minute chart, daily chart. Both of them factor what we call an upside pathway. Upside pathway. We do a lot of market analysis in terms of pathways. And we'll just trade the market as it moves in the pathways in real time. So if in real time the market got above 2020, it probably would go to 2050. And the daily chart even allowed for higher targeting than that. And if you look back in hindsight, that's precise. And this is a real live commentary. This isn't fabricated. This is what we talked about in the market report for members on, I think it was February the 2nd here, so early February. And the next move was the next few days, actually, straight up, clearly planned. So that was the market analysis there. What's happening here? So as the market, we saw it a few minutes ago, down to 2060, and the same thing. This is actually the same thing. It's a real live market commentary from the yesterday, actually, 29th. So there it was. Hit this 2060, and we planned either it comes up or it breaks down. Dominant thesis, logical, probably bounces up. As you saw today, the market gapped up, tested a level one more time, and then pushed off the level higher. This is planning, and some traders just walk in the market and say, I'll do whatever I feel like, or they didn't plan. They didn't take their time to plan not just what should happen, but what shouldn't happen. And of course, how they will react. Remember, the planning is three. This is their current condition. This is the expectation, and this is what you will do in real time. Any questions on that so far? Before we jump into, I'm actually doing very well on time. Questions on the game planning? Tom says good. Game planning support. So what we have, just kind of reviewing a narrative, and we have the game planning, and we had all these things with the support, basically the levels to go on the chart there. So we're looking at planning, dominant thesis, alternate thesis, and of course your indicator chart thesis. So looking at those. All right. So once you have the narrative, in this case it supports higher prices, at least it did, and the chart, we're balanced, we're not confusing ourselves, we have a clear way to mark what a trade is. Next we're going to game plan it. Yeah, the market, precisely, Bill, that's a great point. The market rules. Better think about what it might do. And I would add what it might not do. It would be a surprise. Let's go back and let's hindsight this out, or whatever we call it. The market in this case should move up away from, which is what it did. Wonderful. What would have happened if it didn't? What happened if this was the high, market turned tail and went right back down and broke this level? That's not what should happen. But if it does, you as a trader, swing or intraday, have to be prepared for that outcome. And without bias, without saying, oh, darn it, it got me again. No, you're planning. What was the market going to do? And what will I do in real time? All right, so good questions there. Let's jump into, Manesh mentioned this too. So again, we didn't compare notes. We didn't share presentations. We work together. We're great, I think, colleagues. We think a lot about the market. We've done this for years and years and years. So it would make sense that we've built in some similarities. And Dave says, till the Greece referendum, who knows? My goodness, that's right, isn't it? But then again, I did the briefing this morning, and we're having to plan this out. So I don't look so much at headlines. I don't follow the Greece news. I tend to follow the Fed because I find that interesting, and that tends to affect the markets. But Greece does too, obviously. But I think focus on the charts, focus on levels and plan. The Greece is what was the catalyst that pushed the market down or collapsed the market down from 2100 to our support level. Great. What if we had no idea? What if we didn't see the news at all? I'm just being hypothetical. The market did what it was supposed to do, which was move away from a key level down to a support level. So don't get so caught up that it's the same thing with indicators. Don't follow so many indicators that you can't make a decision. Don't categorize or read or study so much news that you wind up paralyzed. It's the same thing. So even though we don't know, and of course we don't know, we can't sit here and say, well, I'm not going to trade until Greece is either out of the euro, out of the European Union, or not if it's bailed out. Could be waiting some time. So we don't want to just, or the same for a Fed day or earnings. Don't just sit on your hands for news. So that's something with the balance. Yeah, but yeah, good point. I guess bots are off. Oh yeah, good point. All right, okay, dokie. Let's talk about the mind gap, which is the fourth part. Oh, robots. That's what I was thinking too. I was saying the robot. Okay, he said good point, but my bots are off, and bots are robots, so robots are off. Ha ha ha. All right, so the mind gap. This is psychology. And I've given entire presentations. There are entire books written on this. And my goodness, we don't want to spend all our time talking about it. But if you'll notice, balance, 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 fear, and greed. So don't be overly cautious. Don't be overly aggressive. There's usually the answer is in between your strategies. So that's it. I tend to have in my trading style more hesitation, more conservatism and protectiveness and risk-off behavior. That's because that's how I'm set. I'm more academic, I'm more thinky, I'm more researchy than jump out, get a trade on, and hope everything goes well. I would tend more on the side of caution than action reaction. But other people, I've worked with clients and of course I have colleagues that are just the opposite, which is, candle, I'm going to buy. Wait, what? Why would you buy off a candle? Okay, cool. But they're looking for any reason to get in the market because they thrive on action, and they're driven by greed. I'm just personally driven more by, let's say, fear, but driven by wanting to be perfect, and that's of course a flaw. But either way you cut this is psychology. Yeah, research. Yeah, guilty lines 2 and 3. So yeah, fear trading. Yeah, that happens. And by the way, it isn't so much there. When I do well, I overswing greed, and I'll overtrade my account. If I'm doing well, I will say, ha ha ha, I've got this figured out, ha ha, and we'll violate some rules there too. So it isn't so much you're always conservative, always greedy. You tend to your own psychology, based sometimes on even the last couple of trades, will dictate. I'm my actually firstborn and only child, so I'm not sure how that plays into it in terms of Pam asked, are you a firstborn? Like, yeah, I'm an only child. That could be it too. I'm not entirely sure, but there's research on that. Yeah. All right. So fear is just trading in terms of what does this mean? Not being nebulous. Fear or greed. Fear or greed. Fear is some consequences is that you're like me. You overanalyze. You spend too much time in the analytical world, and that means you don't trade a setup when it occurs. You would second guess yourself. You would trade too small. Even if you do put a position on, the position is too small for your account. If you have $100,000 trading one ES contract, probably not appropriate. Probably trade more than one, to say the least. If your account is $100,000, trading 10 ES contracts, probably too large. You're probably falling victim to greed. And that is simply trading too large for your account size, trading too frequently, and trading what isn't really a setup, what Manesh would say is a setup, what I would say is a setup, or what even technical analysis would say for the trading setups there. So trading too large or non-valid. So that's greed and fear. So what it's basically strategy is knowing what to do, and then psychology's mind actually doing it. And the market is adapting to changes. And Pamela says, that's even worse, only child, haha. Engineering thing. Steve says engineering thing. I'm more science and more statistical, but yeah, a little bit engineering in my background. All right, so this is the main factor of setup. It is strategy, knowing what to do, psychology, doing it, and then market is adapting to changes. And just quickly going through this one. So defining a strategy and method is what you trade. Don't just jump from Forex to options to whatever the case is. Your time frame. Set these things up clearly. What creates a specific setup, Ichimoku or Fibonacci or Elliott or trend lines, whatever you do, and how to enter and manage the opportunity. Doing these factors, doing these defined things, will reduce fear and increase the odds that you will act on the opportunity. That way you'll cut through the greed and you'll actually take valid setups, and you'll cut through the fear and you will take, again, valid setups. You won't be caught in confusion. And quickly, if the strategy is not enough, if you're having really trouble, if the market just gets too volatile or something negative happens or you're just feeling a little bit out of whack, out of balance, there's things you can specifically do. Strategy isn't enough. Reduce position size. Reduce the number of setups. If you're trading 3 or 4 patterns, go down to just 1 or 2. Reduce the number of markets traded. Use visualization, mental rehearsal. It's a whole other conversation. So you imagine yourself winning by following your rules. And if a trade goes bad, imagine what you'll do. You won't just be caught off guard. You won't be deer in the headlights. You will know, and yeah, ace, ace is ace. You'll know what to do and handle when trades go bad. So basically visualizing success and handling it's stress inoculation. Handling when trades go poorly. Breathing exercises, if that's necessary, that helps as well. Biofeedback, if that's a more detailed way to go with it. And working with a coach or partner or team. That helps me at least. Sometimes trading by yourself is a lot more stressful. It can be at least, or lonely or isolating than being with a team. And there are prop firms and trading rooms and coaching and all things that are possible for you as well. All right, so finally, any questions on psychology? Psychology questions? We're doing actually quite well on time. So the review, we'll jump ahead to the review gap. And the review gap is, I think this isn't talked about a lot, same thing, like the narrative. It is making every single day a trading opportunity. Every single day is, yeah, Richard says, great, awesome. It's basically making every single day a learning experience based on your trades, based on your specific way you look at the market, your indicators. So review what you are doing, build on what's working, what's successful, and try to eliminate what isn't. Don't, and this is kind of a pro trip, but a pro tip, don't spend all your time working on your flaws. A lot of people, it's logical, it makes sense, but if you have something that isn't working, or you just don't do well in the afternoon, or you don't do well trading momentum environments, whatever the case may be, or range environments for that matter, don't do those. Don't focus on making yourself a pro at something you don't like doing and just naturally aren't good at. There's so many opportunities. Focus on what is strong and what makes sense to you, and build on successes. And Dave says, what about back testing? Same thing. So also don't take strategies or setups or trades if you don't understand the probabilities of success and the different profiles. Breakout trades, fade trades, reversal trades, retracement trades, each have a separate profile. So you would back test those if you are so inclined, and test out your strategy. That also, I guess in the psychology component, increases the probability that you'll put the trades on and manage appropriately. Psychology just means doing the right thing and not short-circuiting, not exiting a trade too early, not sizing too small or too large, or not holding on to a trade after the stop should have been taken or after the target. So it's basically doing what your strategy is saying. And back testing helps you to modify those. So reviewing and learning, this is from yesterday, from our trend day down, again, intraday trading. So June 29. So there was an initial gap. And all this is looking at your particular trades. On a trend day, we in the membership, we trade the same way. We want to short the market. We want to get into the trend development. And we typically do that on retracements. This was a good example of one of the most powerful trend days. I think one of the biggest trend days we've had in 2015. So basically all you're doing, and there's much more specifics, but you're short selling retracements, either to a moving average or just a flag trend line break. And what you're doing is, again, trading in the direction of the trend on a lower time frame chart. All this is studying lessons. You can do this on your own. I do it in the membership. I've done it every day since 2009 when I first started doing this, and it's made me a better trader, specifically because I've been able to understand what I'm doing wrong. Am I holding too long? Am I entering too late? It's specifics of entry, management, and exit. And then looking back when the market's closed and saying, well, goodness, if I would have done this, if I would have done that, this would have been a different outcome. So that's what you're doing. It's reviewing your trades with what was possible in the market. And then Bill says, What about credit spreads with loss possibility of 3x expected profit, even though the overall probability is above 90? That's not something I really talk about. I've looked at that strategy in terms of high probability outcomes, but you're having a large loss, or playing maybe short selling a spread with that's way out of the money. Probably market won't move that far, but it could. So those are examples, but I don't do those in my own trading. When I first started doing the intraday trades or the technical analysis, I did, but that wasn't a strategy that I could really be comfortable with. So I'm probably not the expert to talk about credit spreads, loss probability of 3x with probabilities. That's nothing I would do personally. So this is just this looking at reviewing. It's all it does. Every day we look at, in membership, we do a lesson. So we also, the tick, oh yeah, good question. Thomas, is the bottom tick? Absolutely. So I'm looking at intraday tick, which is this, TICK. It's the really in trade station here, $TICK. It's market internal. Breadth would work just as well, or similarly, and momentum. Again, 310 oscillator. But again, not talking my strategies, talking more generally. But yes, on an intraday basis, I will look for tick divergences and to guide my decisions and see what the message from tick is. So yeah, it's tick, TICK. And that's it. So it's reviewing what happened, trend day versus range day, what lessons we learn, and every single day we do specific lessons. We talk about these, and we have an archive that goes back to 2009 of any type of trade setup, any type of trade day. We divide days at least in terms of 3 of them. Trend day, like this, range day, almost like today, and rounded reversal or failed trend day. And that is how we structure our intraday, which is, again, setting it up and planning it, and then in real time, trading out your positions. So that is the structure. So for the review, a lot of traders, if you do review, and hopefully we do, we don't want to just copy the trades in Excel or GainsKeeper or whatever the case is and just be done. Just copy trades and we're done. Okay, look, here's our trades. We did this one and that's it, and walk away. That's not helpful for improving. Connect your entries and exits to a real-time chart, to a real chart. So whatever you entered and you exited, and you're going to ask this question in hindsight, obviously. Did you enter too early? Did you exit too early? Did you enter too early? Or did you exit too early or too late? So that's it. Entry, exit, early, late. And this efficiency. So if the market touched, in this case number 4, just kind of zoomed in, the market touched the trend line, touched the moving average with reversal candles, that's a short sell. Did you get short as close as possible to that resistance line? Good, your stop was tighter and your target was further away. Or did you wait a little bit longer for the market to break a trend line? Or were you uncertain it would hold and you waited, and wind up jumping in much later when it came down? So that's what we're looking to do. Entry, exit, early, late. And every single day, this is your own particular trades and what are you going to learn and improve. Or if you're a new trader watching someone else trade or watching their things, analyzing those, which is what the webinars and the inside coaching, that's what that does. It just puts traders together and discusses trades. So learning from others, if you're new, is a great way to make progress without having to risk capital. Of course, if you're new, you want to get in, at least in sim mode and in real trading as early as possible to get these real world examples. So that's the review gap. All right, so what we're doing is just that's it, it's filling trading gaps. And the ones I identified today, which is, there's 5, so problem and how you describe it. So if the narrative, if you miss the big picture, you probably would go against a trend. You would have a much more difficult time as a trader, would probably lose more money if you got in with the trend, in with the narrative, in with the bigger picture. That will help you to at least get you on the right side of price action, make your job as a trader a little bit easier. So chart, balance of too many indicators or not enough indicators, and planning, which is, again, will simplify your methods. Planning, no plan, don't know what to do, random, just wake up and hope that a trade sets up. Fine, but it's better to have at least a plan of what the market logically, I don't mean you have to go deep level analysis, but what should the market do? What shouldn't it do? Is it interacting with the level? Is it going toward a level? Is it going away from a level, etc.? And that guides your thinking. The mind gap is, are you overly cautious, like me? Are you overly aggressive, like others? Or somewhere in between? The goal is to be somewhere in between. Your strategies, your method, back testing, just trusting your methods or doing a review, that helps you balance overly cautious, sizing too small, or overly aggressive, sizing too big. And finally, not learning specifics. Just kind of when you're done, you turn the computer off and go have fun. That's great, that's fun, but if your job is to be a professional trader or to make this into a hobby, into a career, you're going to have to work at it. And reviewing is going to make you much better. It will cut the learning curve down very quickly, and I think will help you boost your profits over time and will give you confidence. You'll learn what's happening, what's not. Solution, just kind of closing out, review the trends, narrative, what's driving the market. That's your solution. It's a problem solution. Again, Manesh and I didn't compare that, but it was similar. Problem solution. What's the narrative? Review your trends. Look at your charts. Find out the factors driving the market. Chart, focus only on indicators that work for you. That's specifically your preference. Planning, take the time each evening to plan. Don't just wake up and say, I'm going to hope everything goes well. And some traders do that. Plan the next day. Plan your key levels, support resistance, targets, pivots, trend lines, etc. Relax on your mind gap. Relax, trust your system, stay balanced, stay cool, trust your indicators, trust your strategies, trust the market, and really understand what drives you and focus and build on that. And finally, review your trades, plot the market, draw off your trades, and some even softwares do that for you, software programs do that for you, and that's what all we're going to do. So we're going to focus every single day on getting better. So any questions so far as we move on? We'll do a Q&A, kind of a summary Q&A at the end of it. Yeah, good. Okay, perfect. Thanks, Steve. Thanks, Thompson. Great stuff so far. Excellent. All right, we'll do a formal. I'll mention, as Manesh mentioned and as Cam mentioned, we're offering little bonuses, and so I'm glad that it's happy to do this. Typically, all these are separate items, but I'm happy to do this for Manesh, for the trading group here, and just for kind of a mid-summer, get our energy up and get our enthusiasm up, kind of get us excited about learning and studying and moving forward as traders. So what we'll do is a trend trader perfect pullback. These are really just how we look at trend structure, how we define trends, what indicators may work best, specifics of the pullback, entry, target, stop, talk about specifics of flags, what I call the special impulse buy trade, and TCZ, which is your trend confirmation zone. And of course, all these things here, but this, you'll read more information about this. Normally 60. You'll also be able to get in the bundle access to 2 months as a full member, discounted price, full member of the premium every single day, including the weekend. That's 5 reports. One half of it is education. The other half just planning out the trades, and I'll do some real-time things too. And then more importantly, I think trading out and planning out the next day, as you saw. So that's the S&P, stock scans, and a couple of ETFs. And we'll also do weekly report, which is a bigger picture. Get that narrative, always focus on narrative. We'll actually push that into oil, gold, crude oil, and the dollar, of course, S&Ps and Treasury. So we go beyond just the stock market and look at these, Elliott, Fibonacci, etc. And even beyond that are 2 coaching webinars. I think Manesh is offering this too, in terms of going through trades, talking about an in-depth, in real time, discussing your trades, discussing my trades, discussing what's working, what's not, what's setting up. We'll do this twice, at least twice. And that is the bundle for the membership, 2 in-depth coaching webinars, and your premium lessons. As Manesh was saying, if you want to contact me any point in time, and it's the same, it's $299. Normally about $600, going down to $300 just for you with my appreciation. And thanks for attending, listening, and participating. If you have questions at any point in time, I'm at Corey@afraidtotrade.com. Love to hear from you. I'm a product of success by people that have taken time to mentor me and work with me and in the trading community. I'm happy to do that as well. This is my passion, my interest, and helping you, seeing you succeed is what I am most interested in doing. This is kind of a big kind of research passion and many years of going into this. So happy to help any way that I can. All right, so we'll talk about questions. And he says, we'll go into any questions you might have as we conclude in here. And Bill says, I'm not trading yet, definitely on the overly cautious side. It's a bundle to learn. Yeah, exactly. And don't be overwhelmed. One thing I always want to stress is simplicity, structure, and of course, well, not so much caution, but one day at a time. That's how we started off. How do you eat an enormous something? It's bite by bite. How do you take an enormous journey? Step by step. And how do you become a successful trader? Day by day, trade by trade, lesson by lesson, webinar by webinar, all these things, conference by conference, book by book, blog post by blog post, etc. And that's what Manesh is offering. That's what we're offering. And we're giving any type of information we can, because every single day we, as we share these knowledge, as we do our reports, do our research, it makes us better. And being accountable to the public is part of that. It takes a different level of seriousness and professionalism that makes us rise to a higher level. And so that's a benefit of being in the public eye like we are. But every single day we've done that. We've not known what to do. We started and gone through the journey and kept up the motivation there. So if there's any more questions, let me know. We're out of time here. But Corey at afraidtotrade.com. One question. Let's see. Yeah, real question. Rob says, what I don't get is if a person has a so-called success system to trade and is also selling knowledge, why not billionaires? Linda Rashke, 2005, and Linda was, she's top trader. I have all the respect. And we're colleagues, work together. She got a course for, it was about $1,000. It was the first course I ever took that paid, more than a couple, $20, $30, like the lesson here or there. I paid $1,000 to hear Linda Rashke for a day, and I was so excited. So I just couldn't wait. Linda's a market wizard, and she's respected top of the Traders Expo. And once we got there, the first thing she said, literally, the first thing she said, I'm I guess at this point 25 years old or so. If there were any, there's no magic, she said somewhere along these lines, there isn't any magic indicator. There isn't any magic system. I know a lot of people in the trading business. Trust me, if it existed, I would have it. With my money, access, influence, colleagues, etc., I would know what it is. I would have it, and I would be on the beach sipping, I think she said, sipping a peanut colada and relaxing. But instead, I'm here with you, teaching you, because A, it's my passion, and B, markets change. This puts a lot of research into it, a lot of time, effort, struggle, and everything we do in terms of research makes us better. There isn't a magic indicator that can turn your computer into a dollar-producing machine. And goodness me, if you knew how sad that I was, how upset that I was that I, for $1,000, wasn't going to get what I wanted. But Linda was right, absolutely right. And if you know Linda, you'll know how humble and how down-to-earth, committed, passionate she is. And of course, as some of you are mentioning in the comments, absolutely right. It's day in, day out. We in the public eye become better by working with traders, by working with clients, by working with each other, by researching, by sharing knowledge. Because what was the third? We didn't talk about it, but the market success comes down to knowing what to do, which is finding your own methodology, doing it, which is overcoming your own limitations as a trader, as psychology and mental sort of greed, fear. But that isn't enough. The third part is adaptation, because markets change, and that takes us right back to the beginning, which is narrative. If you have a bull flag strategy that trades wonderfully and you have no hesitation whatsoever trading a bull flag, and it works really well during today's markets, that bull flag bullish strategy would have ripped you apart as a trader in 2008, and potentially if we go into a bear market whenever that happens in the future, doing the methods that you learn now will be harmful to you as the market turns and the narrative shifts. So Linda's right, it's day in, day out. There isn't a way, if someone's trying to make, buy $5,000 and get this one little book and this one little course and boom, you're done. That's not going to happen. It's day in, day out, commitment, passion, motivation, shared knowledge, working in trading communities, working better, and every single day. Linda Bradford Rashke. I'm not sure she's quite doing as many public things, but she's used to be LBR Group, LBR, Linda Bradford Rashke. Market Wizard, Jack Swager, and just a lot of research. She's out there. Linda Rash was one of my mentors. All right. Thank you all for a couple. I see what listening guts for. Yeah, thanks for all the questions, answers, and for your attention. We'll turn back to Manesh, and we'll look forward to seeing you again. Thank you all for attending. Manesh, thank you all for having us.
Okay. Thanks, Corey. If you guys haven't seen in the chat room, Cam has posted the links for both myself and Corey for the special promotions. Just a quick thing, they're available to pretty much to midnight tomorrow Eastern Standard Time. Also, if you guys have any questions, feel free to email us. But the recordings will go out sometime tomorrow to everyone that's registered on the webinar, so just look for it. And for some reason, if you don't get it by tomorrow, you could email us, and we'll follow through and make sure you guys did get that. Any other questions, guys? Oh, Cam, Tom's asking about the bundle package.
Yeah.
We have the link for the bundle package.
First of all, hey, thank you, Corey, so much, and thank you, Manesh, too. You guys both did great, and thank you for your time. So as I mentioned at the very beginning, we're doing a little bundle package that I really had to tug on these guys' arms to get. But I think that you're all really going to enjoy the benefits of it. And they put so much time and energy into doing this, so the price that you're getting is incredible. But what you're going to get with it, with the bundle package, you're going to get some mentoring sessions from Manesh 4. It's going to start next Wednesday. And you're also going to get Manesh's introduction to the Ichimoku Cloud video. And then you're going to get 2 sessions with Corey, mentoring sessions, and then his perfect pullback strategy lessons, and 1 month of his premium blog, which if you haven't seen it, it's amazing. So really the offers that they had, it's both of those offers put together into one bundle for $449, which is an incredible price. So take advantage of it. If you're interested in getting mentoring from both of these guys, like I said, they pour their heart and blood into everything, and you're really going to enjoy it. We'll also send out a follow-up email. So if you, for some reason, can't see the links in the chat box, or you need a minute to think about it, you'll get an email with all 3 of the offers that were made tonight, and also the recording of the webinar as well. So thank you guys all for coming, and have a great night.